Today, ladies and gentlemen, whether you buy in growth stocks or buying your favorite dividend stocks, if you are an individual stockholder, I can almost guarantee you one of your positions is down anywhere from 30 to 50+%. This volatility is leading a flight to safety. I see it in my comment sections. I see it in our chat groups. And that flight to safety, of course, is index funds, because the fun thing with indexes, guys, they'll never drop as much as an individual stock, but it gives you the opportunity down the road is if the markets tank rapidly, you can take advantage, guys, by scaling the index down and then continuing to cost average into your favorite companies. And we're going to talk about one dividend ETF that is largely under talked about by the dividend community that has this little hidden gem behind it that I think is going to make me want to add it to one of my retirement accounts. And we're going to discuss what that is, what those hidden gems are in this video. If it's something that you appreciate, consider hitting that like button, folks. But first and foremost, we got to talk about these markets. We finally got through all the large tech earnings, but we're heading into the second series of earnings for me because the Canadian stocks post mid to end of February, whether we're talking TELUS Communication, my bank stocks, my RioCan. So I'm very excited, looking forward to those earnings, which consider subscribing because of course I'll update those here. But before we get into the dividend stocks, let's just take a look at the markets here into close as of Friday, because the only thing really rebounding a lot is Bitcoin. And I'm glad that I've been cost averaging into Bitcoin here and there, not as aggressively as last year, but I had to pick up some of the dips and that's boding pretty well. But we all know what happened with Facebook here, guys. And it was a shock that Amazon posted worst guidance. Their guidance was like 3% for Q1 against analysts that had it set at 15, and Facebook's guidance was set at 8% on the low end, yet somehow Amazon shot back up to the moon. And a lot of people are speculating that's because they hid in their kind of Rivian investment pre-IPO, driving, up some of their investment capital. And I noticed Ford did the exact same thing, which made their revenue, earnings, all that stuff kind of, jimmying the numbers around to make it look a little better. But nonetheless, guys, congrats, because anyone that bought that Amazon dip, which I still love Amazon, I think these are all great companies, but it doesn't matter. You're holding a company right now, guys, they just got slaughtered on earnings. We're going to talk about those. But before we do, I just want to offer a little bit of insight onto how I feel about these markets as a long-term investment. We are going through the greatest technological shift since the Industrial Revolution. Everything from healthcare. I mean, we just saw somebody get a genetically modified pig heart thanks to, artificial intelligence and genomic editing, guys, to actually make our bodies accept other organs. You know how crazy that is? And that's just the start. The healthcare sector is going through a technological jump. The utility sector, the financial sector, we're going to see smart contracts and blockchain start revolutionizing the way we deal with everything from stocks to financials. I mean, the auto sector is probably the greatest example, right? I mean, think about it, guys. How many times do you think we're going to go through a technological shift? I mean, you think we're going to go from internal combustion engines to electric vehicles over the next decade, and then all of a sudden a decade later we're shifting into something new? Hell no. Do not sit on your hands. This is going to be the greatest opportunity of a lifetime, and I promise you, your future self is going to shake your hand if you are investing today. But how you go about investing is purely up to you. And let's talk about some of those investments people are buying for that dividend cash flow, and whether these are buying opportunities. I'm going to leave that question up to you, and I want to know if you hold these, what you thought about the earnings, because Clorox was one of the most incredible pandemic plays, and I thought would have been one of the greatest stocks. I owned it for a very brief period of time, but it is now down 40% with a PE of 40 and a starting yield of 3.28%, wiping out 5 years worth of gains, guys. I mean, it's only up 11% in 5 years now. Absolutely terrible from, just if you've been buying in the last year. However, a lot of this was driven by the fact that their EPS numbers missed by like 20%, primarily because it's costing a lot more to produce products, supply chain issues, all the usual stuff, right? But the revenue was fine. The revenue was pretty good. So if you can buy this dip, ride through this, I can't see this not being a buying opportunity, but that's just my personal opinion. Don't take it as financial advice, right? Scott's Miracle-Gro. This one has been a gem in my heart. I've never bought into it, but I followed it since the MJ boom, because this was kind of like selling the picks and shovels to the miners, because basically you didn't have to worry about the volatility of the MJ market, but now these guys are looking to spin off their MJ related industries, whether we're talking hydroponics. And it just kind of crushed my heart that this one fell so hard. And they even said on the earnings that a lot of the problems they ran into was not only driven from supply constraints, but the fact that the MJ market is slowing down because of the competition. There's not as much demand or growth behind it like there was. And being a farm boy and just understanding kind of some of the gardening stuff and how peat moss works, which is a huge proponent of their product production, and it's a much easier product to produce than other farming materials. I like this company a lot, but I just can't get over the gains that it wiped out. So, it's trading at a much better PE here, though, a pretty good starting dividend yield. And this thing offered like the craziest dividend reward in the midst of their growth here. If you go look at the dividend history, I think they paid a special dividend of like $5 on a single quarter or something, which was wild. What about Unilever? Unilever. This is a PPCE and fan favorite. PPCE has been buying into this dip, but my problem with Unilever and a lot of these consumer, staples is that they have no growth. These companies haven't been growing for several years, and yet their PE ratios are higher than Facebook. I'd buy Facebook's growth rate any day over Unilever's, but hey, a lot of people like that yield of 4%. They think there's still opportunity here because a lot of those products are obviously staple to society, whether you're talking shampoos, whether you're talking things like with Procter & Gamble and toothpaste and Clorox and all those kind of companies, right? But my problem is the companies I want don't dip enough. As a dividend investor, guys, and somebody that would be buying individual stocks and does buy individual stocks, I always look for the best performers in any weighted industry. And the best of the best is your Procter & Gamble, guys. We're talking about Waste Management, McDonald's, and these companies are barely trading down in the double digits. And your PE ratios on these are astronomical for the growth they offer with yields that aren't that appealing against an index fund. So I don't know what to think about my dividend stocks here, but I do have an opinion, and we're going to talk about one of those dividend stocks in a sec. But just taking a look at Procter & Gamble, it's not down at all. McDonald's, you wouldn't even notice there was volatility in the market if you're owning these companies, right? But again, now I'm starting to shift. I'm starting to realize that I, as well, like you, are probably looking for flight to safety, guys. And I told you that I was looking at a Canadian broader composite index fund, but I'm starting to realize the better buy is probably VYM. Now, I get it. You've probably heard of this dividend stock before, but I'm going to show you something about it that I think you've underlooked, probably even holding an S&P 500 index that should make you feel a little bit better if you're a dividend investor. Now, first and foremost, guys, the expense ratios on these are null. This is why I love Vanguard. Rest in peace, Jack Bogle. You changed all of our lives, making more Americans rich than probably any other investor alive. With a starting yield of 2.76%, I know, guys, this isn't your 3 to 5%, but we're getting stability unlike any company you're going to hold right now. Look at this. This thing's barely trading anywhere. It's still up 50% over the last 5 years. Moderate returns, not much more you could ask for if you're asking for cash flow, that is. But let's look at the holdings here, because when I keep talking about the dividend stocks I want to buy, I always look at the top weightings in the index, because at the end of the day, you need pension funds, you need sovereign funds, you need all of these different people that are managing huge amounts of capital to want to buy into your stock. And if they're not buying your stock, they're buying the index, and that index is weighting all of that capital from the top highest weightings down, right? So take a look at this. JP Morgan, Johnson & Johnson, Home Depot, Procter & Gamble, Pfizer, which is a great buying opportunity here in my opinion, trading down slightly. Bank of America, Cisco, Broadcom, ExxonMobil, Pepsi, for crying out loud, all weighting, only making 25% of the whole portfolio. And the best part is if one of these things start trading out of favor, these ETFs, especially with Vanguard, operate in a way by weighting. So if the market cap starts scaling down, the weighting of the investment starts scaling down automatically. That's why you get such a large exposure in the S&P 500, because Apple has such a large market cap. That's how they base the weighting of the holding, right? But the cool thing is if that weighting goes down, the stock position goes down, and the next company that's weighting up starts taking its position. It's all automated, and it's beautiful, and it offers so much volatility control, guys. And I love this. I love this. I love this. I love this. And the hidden gem behind this, and also with the S&P 500 index, guys, is the dividends are growing. Let's take a look at the 10-year performance of the dividend on the VYM here. Because if you went back exactly 10 years ago, you'd have yields, a quarterly income of about 33 cents per share, or on the higher end, anywhere up to 40 cents. But skip all the way 10 years later, take a look at this. On the low end, guys, 66 cents to the higher end of 94 cents. That's a doubling of dividends. That's over a doubling. On the higher end, that's insane. That's absolutely astronomical for a 10-year performance, right? So if you were getting a 2.5% going into a decade ago, you're now getting closer to a 5% yield off an index. And it's funny because the S&P 500 has done roughly the exact same thing. And the cool part about this index is if you're a Canadian, I'm looking to buy these index funds in my RRSP, and that is the only tax sheltered account that waives withholding tax, because I've told you if you own US companies in Canada, you're going to pay a 15% withholding tax. Somehow the RSP waives that, which is absolutely muy bien, guys. So over the Canadian Composite Index, I'm thinking about just buying that to offer some more stability to my portfolio. And again, guys, it'll ride you through some of the volatility, and then when your favorite stocks continue to dip, either use the cash flow to buy into them or weight the index down. I don't know, guys. It's really interesting to see how, a lot of people start realizing what their risk tolerance truly is. And I'm still primarily an individual stockholder, and I will continue to be. I just recognize what you recognize, and I don't want to see my positions dropping 50%, going up 50%. But at least as the portfolio as a whole, I'm still rounding up to all-time highs, and that could very likely change depending on what we get out of the Canadian economy. So consider subscribing, because we got Canadian earnings coming up next. But stay cool, stay awesome, and I look forward to catching you in the next one.